A lot of investors are asking right now how to survive a real estate crash. They're wondering, I know the crash is coming. It's on the cusp. How do I make sure I survive it and I come out smelling a whole lot better than when I went in? More money's made in crashes than any other time in real estate. Let's find out how. So how do you survive a real estate crash and make sure that you come out of it making more money than you went into it? 2008, 2009, the greatest real estate crash of our lifetime, maybe even in the last 100 years. And what was very unique about that time is it created more real estate millionaires than any other time throughout history. Because the people that were made into millionaires by that recession, they understood some things about real estate. They understood some things about real estate. And one of the key principles of real estate crashes is real estate is what I call a reverse gravity industry. A reverse gravity industry. It will always go up, even if it crashes. What's the typical, what happens after a crash? It starts creeping up and creeping up and creeping up. And that's what happened in 08, 09 to the market we're in today. It's a reverse gravity market. Even after a crash, it goes up. You think about it, you throw a ball up in the air, what does gravity do? It goes up, and eventually it comes down because gravity is pulling it to the earth. Real estate is a reverse gravity market. It always goes up. It might crash, but it's like a bouncy ball. It usually goes higher than where you threw it from. And so the idea with real estate, you have to understand real estate's a reverse gravity market. It goes north completely and indefinitely. Now, yes, will we have crashes and corrections? Always. But it goes north. That's what happens with real estate. And we have decades and decades of data that prove that. So first thing, you have to overarching understand that before we go into how to surviving a crash and how to make sure you position for a crash. Understanding there's never a time to wait to buy real estate. You never wait to buy real estate. So if you're waiting for the next crash, don't do that. You don't wait to buy real estate. You buy real estate and wait, Robert Kiyosaki said. You always buy real estate. Your strategy may change. There may be some times like right now when I'm filming this video, office and retail were really hit by the COVID-19 pandemic. And so those are places I'm not investing in, right? I'm not investing in those assets. I'm investing in assets where people are running to, right? So strategies may change, but investing in real estate doesn't change. We always invest in real estate. We just change maybe what we invested. So how do you really survive a crash to make sure that you're positioned to come out way better than you went into the crash? Number one is by leveraging cash producing assets. You want to invest in assets that produce cash. Do not, please, 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 do not invest for appreciation only. Here's what that means. So you buy a property that's producing some cash, but it's eaten up by expenses, so there's no cash flow, none. And then you're banking on making all your money on appreciation, and then the market crashes. And then it's not only not going to appreciate, it's now going to take not 3 years, but 10 years or 15 years to realize that money. So don't invest in appreciation only, invest in cash producing assets and make sure when you invest in them, they produce cash. This is why I want you to be very careful buying new construction investment property. And I'm not saying that there isn't money in it, but new construction investment property usually sells at market, meaning there's really no cash flow at the beginning. And everybody's banking on increasing those rents over the next 2, 3, 4, 5 years, and then the value coming up and then selling that development project off. But understand, because again, there's no value to add in a brand new property. You're going to move people in at the highest market rate. Everything's brand new. There's nothing to fix up. So there's no value to add to the property. You're banking on appreciation only. So you want to be really careful investing in assets that don't produce cash. Cash flow is an insurance policy for a recession. For example, in 08, 09, when the market tanked and blew up and we truly, truly crashed, what happened? I looked at multifamily and I watched the value tank. The property that was worth $1 million is now worth $200,000, $300,000. Grand. It just plummeted. But guess what didn't plummet? Cash flow. In fact, cash flow went up because a lot of people lost their homes and they were thrust to be renters into the commercial real estate market, whereas multifamily being where I live, so a lot of renters, the demand for rentals went up, so cash flow increased. Yeah, people lost their net worth, but you can't take your net worth to a bank to pay for things anyway. Your net worth is just a stated number that people use for bragging rights. It has nothing to do with your ability to buy and sell things. And so, but cash flow does. Invest in cash producing assets. That is a recession-proof That's a recession-proof investment unless you're investing in something that can be taken away. And so we're going to talk about that in a minute. But make sure you invest in cash-producing assets. Number 2, don't use ARM loans. ARM loans are adjustable rate mortgage. Don't use ARM loans, and I'll tell you why. This is one of the reasons the 2008-2009 crash happened. So many people came into these loans and banks were lending out, instead of 30-year mortgages, they were giving 50-year mortgages on ARM loans, 0% down. So I could go to a house as long as I had a job, or to a bank as long as I had a job. I could get the loan, 50-year mortgage, no money out of pocket. Well, when you stretch a 30 to 50, why do they do that? Because they can get that monthly payment down to match their budget. But when that adjustable rate mortgage period ends and the rate can adjust with the market and interest rates start going up, that payment inflates. And when that payment inflates, it can inflate past your budget. And when it inflates past your budget and you can't make the payment, we have what's called a foreclosure. So when you have an ARM loan, you set yourself up. I don't have any ARM loans because I don't trust them. I don't trust the interest rates, especially when the interest rates go down to 2-3% like it did over the last year. I don't trust that. And now it's coming back up and correcting itself, but that's pretty untrustworthy to leverage on an ARM loan. Say, oh, I'll leverage it, and then if the interest rates go down, my payment goes down. So a lot of reasons why people leverage the ARM loan is because they're thinking, well, I'm locking in at 5%, but what if it goes down to 3? Our payment's going to be even less. That's true. It will be. But if it goes up, the same happens. Your payment goes up. And a lot of times that can inflate past your budget. So you want to be really careful leveraging ARM loans. In fact, I would say careful to the point of just don't do them. ARM loans can really sink you, and that's what happened in 08-09. Let's not do that again. Number 3, don't buy emotionally. The number 1 driver of failure in real estate is emotions. I am what's called a non-emotional buyer. I have 0 passion for roofs, windows, bricks, and driveways. 0. But I own a lot of them. I have 0 passion. I really have passion for 2 people, investors and tenants. That's my passion. My passion is to help people leverage their money without having to work and giving tenants an amazing, safe, clean, unbelievable place to live with their families. Those are the 2 people I'm passionate about. That's why I'm in real estate, not because of the asset itself. So when a deal comes my way and I make an offer and I lose it, we have a philosophy at Titanium Capital. It's called on to the next. So let's say a deal comes through and we lose it. Okay, on to the next. Or let's say a deal comes in and we get it. Okay, on to the next. It doesn't matter because I don't want to ever buy in emotion. I don't want you to either. I found out yesterday morning I lost out on a $7.3 million multifamily property, brilliant property, gorgeous property. It was 67 units in Kentucky. So pumped about this deal. Went and toured it, spent money to go look at it, and I got beat out by another investor. Okay. On to the next, because it brings no value to the situation to bring my emotions to the buying table or the selling table. So again, understand buying with emotion will get you in trouble, especially if a recession's coming at you. So you want to make sure you buy on logic and strategy and data. Don't buy on emotion. And I know, especially if you're talking about buying a house, your own personal residence, it's tough to not tie emotion to that decision because this is where your kids are going to be. Or maybe, your kids are already grown up, but this is where your grandkids are going to come over and have Thanksgiving. And there's emotion in that. But let me tell you, get emotional about the experiences. Whether that happens in house A or house B, those experiences will mean the same to your family. So don't attach the emotion that needs to be left in the experience with family or in the experience of wealth building. Leave that experience there. Leave the emotion in that. That's emotional. That's amazing. Don't bring the emotion into the brick and mortar and driveways and windows. Who cares about that? We want to just get a house where we can have our amazing experiences, get an investment that's going to generate revenue for our investors and create great places for our tenants. There's no emotion in the building itself because I can just go find another building. And same thing with you. Again, don't buy on emotion. That'll get you in trouble, especially on the cusp of a recession. Number 3, don't buy more than you can afford. So here's one of the things that a lot of people do. Instead of looking at the cost of a house, people don't really think about the cost of a house. So if the house is 500 grand, they don't think about 500,000. They think about 12, 13, 15, 1700 a month. They look at the payment number, the monthly payment number, not the cost of the house, which is fair because you make money month after month after month. And I get that, and week after week after week. So we're thinking encapsulated. We don't want to have more month at the end of our money, so we make sure that fits into our monthly budget. Yeah, and that's fair. That's a good way to look at that. But again, you want to make sure you don't push past that. If you've ever go to buy a car and you said, my range is $17,000 to $20,000. I want to buy a used car, $17,000 to $20,000. That salesman is going to push you as far as he can to the edge. I guarantee you, you'll never tell them 17 to 20 and they'll find one that's 16 or 17. They'll find one that's 22 or 23, just outside your budget. Real estate agents often will do the same thing. They'll find one just outside your budget and try to back in and say, well, it's only like an extra $32 a month in the payment, so you should be fine. Don't exceed your budget. Again, this goes back to emotionality. Don't bring emotion to the buying table. When you're looking for a house, set your budget and don't go over it. Don't go over it. And I always like to say your monthly house payment with mortgage and insurance should not be more than 25% of your monthly income. Don't put it more than 25% of your monthly income. That makes you a little bit more recession proof. Now, if you're on the investing side, you're investing in real estate, what makes you more recession proof on the investing side, not only cash flow, but also buying in markets where people are moving to, right? And so when you're looking at buying and when you're looking at investing, don't buy more than you can afford. Don't buy more than you can afford in the investing space means don't invest in something that doesn't have cash flow. In the home buying space, it means don't invest in more than you can afford per month or more than 25% of your monthly income. Number 5 is increase your cash reserves. Increase your cash reserves. Because going into a recession, when prices go down, you want to be cash heavy so that you can buy up those assets. So coming into one of the ways you can weather the storm of a crash is having cash on hand. Because you can invest in those assets and you can actually come out of the crash with an amazing amount of money. Now, there's a couple things you can do, especially in a market right now, to increase your cash reserves. The very first thing you can do is, number 1, cut unnecessary spending. Cut unnecessary spending. If you have a cable bill, a $120 cable bill and you watch it 3 times a month, cut that thing and read. Get that thing out of your life. You don't need it. A lot of people have 48 streaming services and they only use one of them for one show. Okay, cancel all the rest. The amount of money that's just wasted every month is astounding. So you want to be more cash heavy coming into a recession, but I want to teach you a little bit on what that means to be cash heavy. So the first thing is cut unnecessary expenses. Get all the junk spending and limit consumer debt. You want to get out of consumer debt so that you don't have money going out of your pocket every month for stupid things that don't really add value to your financial picture. So again, we want to be cash heavy. And the first thing is cut those unneeded expenditures. Number 2 is refinance your property. You want to refinance your home so that you can suck that cash out. So let's say interest rates are 5.5% right now, and they may go up or down depending on when you're watching this video, but check the interest rates. You take a loan out on your house and you take that money and you have it on hand to invest in something that produces cash. Having cash on hand through a refinance is a great way to put cash in your pocket so that you can generate more cash with that cash. It's a great recession-proof tactic. Number 3 is learning how to raise private capital. Learning how to raise private capital in times of a recession where you can generate cash and be cash heavy. So if you learn to raise private capital when a recession comes, you can raise that money and buy up all kinds of distressed assets and watch your net worth skyrocket over the next 4 or 5 years. So again, learning to raise private capital. And check on the channel because we have a lot of videos on capital raising and what to do with a large sum of money. We have some videos that will help you raising private capital. That's one of the things that has blown my business and life up, is learning how to partner with investors for real estate, because it doesn't matter what's going on in the recession. I might change my strategy, but I can still leverage private capital. It's a great way to continue to build assets and build things that create wealth and weather the storm of a recession. And number 6 is leverage fixed debt. You want to leverage fixed debt because the more debt you have, it hedges against inflationary times. Because as the market goes up and down and you lock in on debt, because you can always refinance that debt if the interest rate plummets. But if the interest rate goes up, you're locked in and you've got that money working for you. So leveraging fixed debt helps you weather the storm of a recession because they can't call that if it's a fixed debt. If it's fixed, they can't really call that, and that you're under contract for that debt. And you can continue to pay off that debt throughout the recession as long as you have cash coming in. And that's the power. So leveraging fixed debt will hedge against inflation. It'll be okay if interest rates go up and down, because if it goes down, you can refinance. And if it goes up, you're locked in. So leveraging fixed debt is a great way to kind of recession-proof you against the kinds of things that can happen by leveraging debt and using that money, not for consumer goods, but for investments. And one quick bonus tip, invest in as many cash producing assets as possible, but make sure you're investing in usable assets, meaning don't invest in things that if an industry goes away, they go away. We found this out with the office building industry throughout COVID. Something happens with COVID, drives everybody home, there's a lot more office space. So when you're investing in real estate that businesses use, you're always tied to the industry. Retail space, industrial, office space. Now, industrial's skyrocketing right now because everybody's shipping stuff, but if that ever slows down, then industrial will become a little bit less sought after. But if you use and go after consumer products, real estate people use every day. Multifamily real estate, people are always going to need a place to live. Mobile home parks, people are always going to need affordable places to live. And then storage units, the more as we become a rental nation, people need places to store their stuff. These are usable assets. Investing in those usable assets are a lot more recession proof than a single family home for you or houses that are going to plummet in value and don't really create cash. Make sure you look around our channel on how to invest in real estate and really grow your wealth. And make sure you also look at the video on Is a Crash Coming? Because again, this is really important if you're going to weather this crash that's coming, and make sure you understand the mechanics around the crash. Also, make sure you hit that thumbs up button and subscribe to the channel, join our family of entrepreneurs, and also go into the description and click that link and get our free ebook, How to Create Wealth and Manage Money, so that you can start doing that right away. I'll see you in the next video.